This is the first of video lectures from Chapter 1 of your federal tax textbook. This covers Introduction to Taxation and Federal Tax Law. I thought it might be helpful just starting off to talk about in general what taxation is. So here's a good definition. Taxation refers to compulsory or coercive money collection by a levying authority, usually a government. The term taxation applies to all types of involuntary transfers and levies, including income taxes, property taxes, sales taxes, estate and gift taxes, and so on. Though taxation can be a noun or a verb, it's usually referred to as an act. The resulting revenue is usually referred to as taxes. The Internal Revenue Code is 74,608 pages long, 187 times longer than it was a century ago. Taxation is important to accounting professionals who generally focus on assisting clients with these four activities. First of all, compliance with the tax laws. As an accountant, you want to help your clients to stay out of hot water and to pay the taxes that they're legally obligated to pay. And so helping clients understand their obligations and comply with laws is an important part of what many accountants do. Planning so as to legitimately minimize tax liability or delay tax payments if you can't avoid them legally. The legal minimization of taxes is called tax avoidance, and I encourage that. The illegal minimization or understatement of taxes is referred to as tax evasion. I strongly encourage you to avoid that. Rule number one, we've covered these in class, I'm pretty sure. Don't pay taxes that you don't owe. Know what taxes you owe. Pay your obligations. And number two, don't pay taxes early. If you pay taxes early, you're really making an interest-free loan to the government. So hold on to your money longer, use it for your purposes that benefit you and those that you have concerns for, and then pay your taxes when they're due. Taxation is important to accounting professionals also because they generally need good cash management to be able to pay those obligations. Especially if there are large amounts owing, you want to help your clients understand what their obligations are and be in a good position to pay those when they come due. And number four, dealing with the IRS or state tax authorities to resolve questions or disputes. As a tax preparer, you really are obligated to stand by the return. That is, your diligence in preparing that return, the knowledge that you possess, and that's conveyed really through the positions that you may have taken on a return. So these all are parts of what many accountants do in assisting clients with meeting their tax obligations. Where does the money come from? Exhibit 1-1 or 1.1 in your book provides a pie chart of this, and I've got it on the next slide there. So go ahead, use this pie graph and fill in those blanks on the form in your notes. What you see here, of course, is that some 47%, almost half of federal tax revenues come from individual income taxes. Another large portion, about 32%, comes from payroll taxes. And then about 13% comes from corporate income taxes. A number of other taxes make up smaller, and levies make up smaller amounts. So you can see the lion's share of federal tax revenues come from individual payroll taxes, individual income taxes, payroll taxes, and of course corporate taxes as well. The U.S. Constitution, Article 1, Section 8, authorizes the Congress to lay and collect taxes, duties, imposts, and excises to pay the debts and provide for the common defense and general welfare of the United States. There are really two, parts of that have come under scrutiny or been often criticized when it comes to taxes. The first notion that the Congress shall have power to lay and collect taxes. The notion of laying is to say, here's how much you owe. And collecting is, here's a way that we expect you to pay or that we're going to collect that tax. But many would protest, saying that throwing 74,000 plus pages of Internal Revenue Code in the laps of a taxpayer and saying, here it is, you figure out your taxes, and then you tell us how much you owe, and you better be right, or we're coming after you with penalties and interest and such, that maybe that's not fulfilling the government's obligation to lay and collect taxes, which would imply that we tell you how much that you owe. The other part, of course, is what the taxes are used for. That is to provide for the common defense and general welfare of the United States. Common defense is pretty well understood. I think even across the vast political spectrum, from conservative to liberal, you will find people who would argue that yes, it's a requirement of the federal government that it provide for the defense, that it protect its taxpayers from enemies domestic and foreign, that they provide for police forces, court system that can prosecute lawbreakers and also protect against foreign invaders and other foreign threats. On the other hand, general welfare is a very, very broad in just on its own, very concept. And we probably all of us have different views about what the government should be doing. And there are some things that we would all recognize the government should be doing, like defense, and some things that probably the government shouldn't be doing as well. But anyway, this Article 1 of the Constitution provided the constitutional framework, the justification for providing a source of revenue for the new government. But there's still some controversy surrounding that. President Gerald Ford once said, "A government big enough to give you everything you want is a government big enough to take away everything you have." Here at Faulkner, one of the things we want to emphasize is your own personal responsibility and accountability. You should be able to support yourself and have that as a goal, and not to rely unnecessarily on the work of others. It seems to many of us that there is a growing sense in this country of people who think someone else is responsible for them, that someone else is responsible for providing their education, their health care, their housing, their nutrition, their retirement, and the list goes on and on. And very often it seems we expect things of government they can never really provide. And one of the things we want to emphasize to you is your responsibility to provide for yourself, to be able to provide for not just you, but for those around you, and also, of course, from a Christian perspective, providing for yourself, for your family, and also to be generous toward those who can't provide for themselves. There's a basic tax calculation formula that we'll use, and as you can see here, calculating the tax liability is simply a matter of multiplying the tax base times the tax rate. The tax base is the amount subject to a tax, and the tax rate, of course, is the ratio expressed as a percentage that's multiplied by the tax base to obtain the tax liability. As I mentioned in class, the tax liability is the total amount of taxes that you owe on your tax return. It may be you've already had some money withheld. You may recall we said that the federal tax system, like many, is a pay-as-you-go system. You actually are required to make deposits, or your employer is required to withhold portions of your estimated tax liability, so that when you do settle your account with them, with the federal government, and you file your return for the year, that you don't have a large amount owing. You, for the most part, have paid as things moved along through the year. Let's look at a quick example, a very simple example of how a tax liability might be collected. If taxable income is $20,000 and the relevant tax rate is 10%, the tax liability is a pretty simple calculation. $20,000 times the tax rate, 10%, gives you a tax of $2,000. So the tax base here is $20,000. That is the amount subject to the tax. The tax rate, 10%, and the tax liability, $2,000. To complicate it just a little bit, imagine the taxable income is $28,000, and the tax rate schedule works this way. That is, that the first $20,000 of taxable income is subject to a rate of 10%, but that income above that $20,000 is subject to a 15% rate. What's the tax owed on $28,000 of income given that tax rate schedule? Well, the first $20,000 is subject to the 10% rate, so the tax on that is $2,000. But that $8,000 above the $20,000 is taxed at 15%. And so 15% of $8,000 is $1,200, and so the total tax liability is $3,200. So we actually see here two different rates, a rate that applies to the first portion of income and then a higher or progressive rate on top of that. And so that yields for us a couple of different measures of tax rates, actually. The marginal tax rate is the rate that applies to that next increment. We often say it's the rate that applies to that next dollar of income. And the average tax rate is the tax liability divided by the tax base. The tax liability in dollars divided by the tax base in dollars. So let's determine the marginal and average tax rates for examples A and B above. Well, in the first case, the marginal tax rate and the average tax rate are exactly the same, 10%. You see that 10% applies to every dollar of income in the entire income range. And presumably, if there's more income, it also will be subject to the 10% rate. So whether you figure it, actually do the calculation and figure the average tax rate is $2,000 divided by $20,000 or 10%, or you just know that it's going to be 10% because it applies to any income in that range, marginal and average tax rates are 10%. It's just a bit more complicated for case B, because the marginal tax rate, that is, if the person earns $28,001 in income, that next dollar is subject to the 15% rate. So marginal tax rate is 15%. The average tax rate, we have to actually do the calculation here. $3,200 was the tax liability divided by the total tax base of $28,000. So the average tax rate is 11.4%. Notice it's always going to fall within the range of let's say the lowest rate in that income range, 10% in this case, and the highest range, 15%.